numbers, but where we stand as a company, because fiscal 26, in my view, is a year that will be looked back on as a genuinely significant in UltraTech story. And fiscal 27 started with an achievement of major milestones. UltraTech crossed 200 million tons of cement production capacity in India, a first for any company in a single country outside of China. Let me put this in context. We reached 100 million tons in 2019, added another 50 million tons in 5 years by 2024, and we completed the journey from 150 to 200 million tons in less than 2 years. This is a feat even more remarkable since we are a full year ahead of our targets as what we had set for ourselves. Let's be clear on what the number means. It's not simply a headline. It's an expression of a strategy to build scale that compounds in cost efficiency, in market reach, in raw material security, and in sustainability. Every ton of capacity we add reinforces every ton that came before it. Let's look at our position globally. Outside of China, UltraTech is today the largest cement company in the world by sales volume, and we are the only cement company anywhere in the world to have over 100 million ton of production capacity within a single country. We are 200 million tons. These are not rankings we have stumbled into. These are the results of a very deliberate strategy, disciplined organic growth, timely acquisitions at the right price, and a relentless focus on execution. From somewhere 65 million tons in 2016 to 200 million tons today, we have more than trebled our capacity in a decade. Our next horizon is already set. We have committed to add a further 37 million tons, which will take us over 242.5 million tons in a phased manner by fiscal 28. Now, I want to speak to something that is very much on everybody's minds, the conflict in West Asia and what it means for us. Whilst I have given an indicative chart in our presentation on where the impact of these rising prices could be, let's be straightforward. It's a real headwind on fuel cost, packing bag, and freight, on certain import-dependent supply chain, on near-term sentiment in some demand segments, and the way all oil prices are, we could see an increase in domestic prices of petrol and diesel. The government's monthly economic review for March 26 also acknowledged that the outlook has become slightly uncertain. And yet, India's structural growth story is entirely intact. Government capex is flowing. Infrastructure execution continues. Housing demand is robust. IMF has also raised the growth forecast for the country. Just to rattle some numbers out for you, India did approximately 10,660 kilometers of highways in fiscal 25 and has maintained the pace in 26. The PMA housing program is driving cement consumption at scale. That tells us something important about the underlying demand base. On the construction cost environment, cement prices have been largely stable in the last financial year with movement of maybe 0 to 5%. Steel prices have seen volatility. West Asia situation is near-term cost moderator, not a structural demand reversal. And we believe UltraTech, with our domestic strength, our 1.8 gigawatt green energy platform, our scale-driven cost efficiency is better positioned, much better positioned to manage through this environment as well. Fiscal 26 was a year of extraordinary execution. We crossed 200 million tons. We completed brand migration for both India Cements and Kesoram ahead of schedule. We continued building our green energy capacity and we delivered volume growth and improved profitability. We said we would do these things, we have done them, and we enter fiscal 27 in a stronger strategic position than at any point in our history. Let me look at the Q4 performance and the full year performance. And we'll also share some insights on the integration stories and our cost efficiency program. Consolidated sales volumes, as you have already seen, has crossed a rocking 44 million tons this quarter. Most important aspect about it to note is that UltraTech as a brand, year on year, has grown 19%. Nobody can take away that thunder from us. Realizations improved during the quarter. Grey cement pricing strengthened about 2.5% in most geographies, supported by an improving trade mix and premiumization. A blended cement share, premium portfolio contribution, both moved higher, which is a conscious and a deliberate strategy going forward. EBITDA per ton, excluding acquired assets, is at 1296 per ton for the quarter. For the context, this metric was 1225 in Q4 25. The trajectory has continued. On an aggregate basis, we have reported 1253 rupees per ton in Q4 26. This, if I were to split between India and overseas, thanks to our UAE operations doing very well, they have contributed substantially. But India has been no less. Remember, the India capacity is almost 196 million tons during this year. If I were to remove the aberrations of West Asia crisis, we have achieved EBITDA per ton of very close to 1240 rupees per ton. What am I knocking out from here? The last month increase in cost of bags and impact of exchange loss, the highly volatile and the frantic devaluation of rupee that happened in the last month. So I believe we have done very well on EBITDA per ton as well. A renewable energy platform has been growing from strength to strength. Today we are almost at 43% of our power needs being met from green sources. We have committed to reach about 85% of our power requirements from green energy by the end of fiscal 2030, and we are very confident of reaching that position. On the fuel side, we are actively managing our mix, optimizing between petcoke coal, alternative fuels, and increasing the share of domestic coal wherever required, wherever possible. On the logistics front, our lead distance has reduced to 367 kilometers. Our ever-expanding bulk terminal network, including the new Lucknow facility and other facilities, are helping us reach the customer faster, thus helping us reduce our lead distance and our overall costs. Let me spend a few minutes on the two acquired businesses, because the progress is, I believe, fantastic. Brand migration. 100% brand migration has been completed at the end of March 26. In second quarter fiscal 26, we were at 31% of ICL volumes and 55% of Kesoram volumes were carrying UltraTech brand. December 25, they had moved to 58 and 69%. We have completed at the exit of March 26, 100% brand conversion. The EBITDA trajectory. India Cement's EBITDA of 497 rupees per ton in Q4 26, up from 333 rupees in Q2 and 305 in Q3. Sequential improvement every quarter since acquisition. This quarter, the company declared a PAT of 60 crores for the quarter, which has been after a very long time. And this 497 rupees EBITDA per ton, please understand how we read it. We, as you know, under the related party transactions, we had put in place a tolling arrangement ICL or India Cement manufactures and sells the UltraTech brand, but does not carry any direct marketing and distribution costs. Those sit with us at the consolidated level. At UltraTech, we charge a markup per bag on ICL volumes, which offset that element on a net basis. So India Cement's underlying operational progress towards UltraTech system is much higher than 497 per ton. And the price improvements, selling price improvements that happen in the southern markets will give it a further boost. The investment phase is now underway. We had committed 1592 crores for India Cements for efficiency improvement, plus another 400 crores for capex on capacity expansion. This definitely is gonna take us over 1,000 rupees per ton as committed by the end of fiscal 28. We are spending 400 to 500 crores for Kesoram cement assets. They are already operating at 1,000 rupees EBITDA per ton, more or less in line with the other cement operations in South. These two assets today represent about 13% of our consolidated capacity. They are moving from integration drag to earnings contributor. As their cost improvement capex matures, they will be a meaningful and growing source of group level EBITDA accretion. Let me now look at how we see fiscal 27 and beyond. We expect a sustainable volume growth of 7 to 8% per annum. The structural drivers are firmly in place. India's urbanization story, the government's infrastructure commitment. You would have read about Mumbai city itself spending about $60 billion in improvement of infrastructure. The PMA housing targets, rising rural demand, none of these have been diluted by the West Asia crisis. These are very strong structural forces, and UltraTech is better positioned than anybody else to capture that demand in the long term. The near-term environment has its complexities. Nobody knows what will happen tomorrow, what will be the new comment that gets made which could move the markets. We will wait and watch. On the integration side, we are through the hard work. Both India Cements and Kesoram are fully migrated to the UltraTech brand. Cost improvements are underway, and fiscal 27 P&L will start reflecting the benefits of this investment. I should definitely mention about the dividend the board has discussed, debated, and proposed. Our balance sheet remains robust with a net debt EBITDA of 0.94x at a consolidated level and 0.92x at UltraTech India level. This gives us financial flexibility to continue investing in growth without compromising on returns to shareholders. We have already started charting out our growth story beyond 240 million tons and will come back to you next year. The board has recommended a dividend of 240 rupees a share for fiscal 26. This dividend has been stress tested against retained earnings, remaining adequate for all planned investments and commitments. Credit metrics and debt covenants are unaffected by the proposed distribution. We'll maintain our leverage below 1x year after year after meeting our growth capex. And our growth capex requirement is not shrinking. We see a plan of investing around 8 to 10,000 crores every year for the foreseeable future. Future capex pipeline remains fully funded and the growth story is intact. It's a cumulative outcome of disciplined capital allocation, operational excellence, and consistent strategic execution over many years. We know it, you know it, our operating cash flows are growing, and our board has already taken a stance of improving the returns to shareholders. you would have seen our dividends grow from 10% of profits in 2020 to 37% of profits last year. And today we are where we are. Dividend is not simply a financial transaction. It is a communication of our confidence and commitment to our shareholders and investors. It says, we are confident in our earnings quality, in our forward outlook, and in our ability to generate and sustain value. We are not keeping cash on balance sheet out of uncertainty. We are sharing it because we can and because we have planned carefully enough to do so without any constraint. I want to close with something very simple. UltraTech has made commitments to investors on capacity, on integration, on brand transition, on cost efficiency, on sustainability, and on returns to shareholders. Year after year, we have delivered on these commitments, FY26 being the top-notch performer. We said we would reach 200 million tons ahead of schedule. We did. We said we would complete brand transition for ICL and Kesoram. We did, and a quarter early. That consistency of delivery, ladies and gentlemen, is what defines UltraTech. And it is what will continue to define us in the decade ahead. Thank you, and we are now ready for your questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Rahul Gupta from Morgan Stanley. Please go ahead.
Hi, thank you for taking my questions. First of all, congratulations on hitting 200 million ton capacity, domestic capacity, and a very good set of numbers. So I have 3 questions. First, just continuing on the capital allocation point that you made, Atul sir. Thanks for the clarity on that. Just to be clear on this, is it fair to say that given balance sheet strength and you funding your capex through internal accruals, we may see payout ratios staying higher for foreseeable future?
I think so, but it will depend on the board and company's performance. If we perform, if the cement markets do well, I think it should be possible.
Got it. That's very helpful.
And most important point, Rahul, I would want to make is, and I think already said it, but I want to repeat. Next few years, we are in 26 till 2030 to 31. I will see 8,000-10,000 crores of capex happening from our balance sheet every year. And as the operating cash flows grow because of our existing size, existing capacities, delivering more and more, the size of operating cash flows keeps increasing, making it very easy for the company to reward its shareholders.
That's exactly the point. Yeah, very, very helpful. Yeah. My second question is on realization. You to some extent have clarified how realizations have been better this quarter. Your share of trade has improved, direct sales have improved, and brand transition of acquired assets has also ramped up fully during the quarter. So am I missing something over here, or is it the brand transition completion has helped in giving you the edge in terms of realization during the quarter?
Significantly, because if I were to look at, let's say, India Cement's volumes for the quarter of 3.12 million tons, non-UltraTech volume was 0.39 million tons only. So we have had and everybody knows that UltraTech enjoys a premium positioning with brand transition that has definitely helped. Jamaji, you want to add?
Yeah, very good afternoon. And I would add further what Atul said. Actually, fundamentally, I think it is working on all engines. Actually, there are number of moving parts in the cement. Actually, so one, yes, of course, the brand transition Atul has clarified, which is rightly so. But there are so many other, at least 4, 5, 6 critical moving parts actually, which also helps in a big way to improve the efficiency and at the end of the day resultant into the improved cost structure or the higher profitability.
Got it. And my final question is, first of all, thank you so much for sharing data on slide 6. Now, my question is that in one of the slides, you have mentioned that other OPEX got some impact of the West Asia crisis. Can you help us quantify what that would be and how should we see June quarter, assuming this current situation continues?
So firstly, on slide 6, I've just given an indication what could be a potential impact, and this cannot be annualized for the quarter. So please don't panic too much. And yes, in the last quarter, the immediate impact was because everybody has inventories of fuel, so nobody would have really felt the heat of rising prices of fuel. But bags became a crisis in the month of March, and everybody got impacted. The cost went through the roof, and our incremental cost on bags was approximately 90 crores, which is reflected in other costs for the quarter on account of bags cost going up. Hello.
Got it. Thank you. And any color on how should we look at power and fuel cost for the June quarter?
I don't think there will be too much of an issue in the June quarter, and I will urge you, Rahul, to fly down to the White House and do something about it.
Well noted, sir.
So, no, I don't think so. It will be too much of a pain. Prices are going up, which is a reality. Selling prices have also been increased to cushion the impact of rising input costs. Another important one-off, which we are not even talking about, but the fact is the way rupee devaluated. I have $950 million of foreign currency borrowings. $950 million of foreign currency borrowings, fully hedged. But when you have to do a mark-to-market, you have to take the impact of that currency into accounts. It hits your EBITDA. 94.85 was the rupee to dollar. 31st March, it corrected. It strengthened by almost 1.8. It corrected on the 2nd of April 1.8, but we have to account for the dollar borrowings at 94.85. It's a notional, it's a debit to the non-cash debit to the P&L, but so be it.
Got it. Well understood. Thank you so much, and wish you all the best, sir.
Thanks, Rahul.
Thank you. Ladies and gentlemen, in the interest of time and fairness to others, we request you to restrict to 2 questions per participant and rejoin the question queue. We take the next question from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
Sir, thank you for taking my questions and commendable results. Very good quarter. So my first question is, you spoke about brand conversion having completed it in March. Could you highlight between March end and now how much has been the impact of this on India Cements and Kesoram?
So, Kesoram, if I look at January-March quarter, it was already operating at 1,000 plus EBITDA per ton. And everything else remaining the same, India Cements will improve further because, again, I called out of 3.12 million tons, only 0.39 million tons was non-UltraTech brand, 2.73 million tons already rebranded. So everything else remaining the same, the impact will be felt on this, less than 500,000 tons of volume in Q4. Having said that, price improvements and the real efficiency and integration benefits will start flowing now. To better explain, Pulkit, now it'll be one product which is leaving from all the 11 factories of 9 factories of India Cement, as compared to earlier days. There were multiple brands going out, not just two, but there were more than 2 brands going out. So the real efficiency, which will be visible in logistics now, seamless operation will be visible now. My performance will go up further in terms of earnings potential from India Cement.
This is very clear. So secondly, I'm just following up from the question from the previous participant on the slide 6, where you speak about the impact of West Asia conflict. And while clearly, longer term, you've been able to manage costs really well, etc. I'm just wanting to understand, these costs are quite meaningful because you mentioned in one of your remarks saying that, these are manageable. I just want to understand, like, based on just rough math, this looks to be fairly high in terms of its impact. So any mitigating measures that you can highlight which gives you confidence that you'll be able to manage through this?
Yeah, there are several measures, and for the sake of confidentiality, I might not be able to reveal trade secrets. But, diversifying my sources of procurement, identifying newer opportunities to deal with the situation, doing long-term contracts for fuel, which are going to be beneficial to us now. Last 2 years, our long-term contracts were going against our, against our decisions, were unfavorable. These will become favorable for us, and nobody has them. So UltraTech will be one step ahead. Again, bags, we have nearly 150 odd suppliers across the country. And when there is a volume advantage for a supplier, obviously their inclination to service a high volume customer is much higher. Diesel impact, nobody knows. We are waiting. It might surface its horns next month. We'll have to wait and watch.
Fair point, sir. Fair point. Maybe can I slip in one more question if you allow?
Yeah. Go ahead.
Okay. Sir, this is, you've mentioned the capex you've incurred on your cable and wire business, and I know the numbers are small, but just to get an understanding, 800 crore out of 1800 crore has been spent. Does it mean we are on track for a end of the year launch, or it could get slipped?
Yes, okay. Pulkit. And since you cover this sector in so much detail, you know what the implication is. I don't have to spend so much money.
Yes. Sure. So we are on track.
It speaks for itself. And my guess is we should be on track, on time. We had committed Q3. We might be in the first month of Q3. We might launch instead of waiting for December.
Superb. Thank you, and great results as always. Thank you.
Thank you.
Thank you. We take the next question from the line of Prateek Kumar from Jefferies. Please go ahead.
Yeah, good evening, sir, and congrats for great results. My first question is, can you discuss sequential improvement in your performance, stripping out international operations, which was also done well during the quarter?
Sequential as in quarter to quarter? What do you mean?
Yeah, quarter to quarter. Like how much is it seems like international operations have also contributed to sequential improvement of overall.
Yeah, so you know what, but they are only 5 million tons of capacity. One thing is that before the war broke out, they were operating at 100% capacity utilization. There was a drop in capacity utilization which went down to about 80%. Now with the permanent peace program being there, capacity utilizations have started going up. Prices have started going up. So they are doing well for themselves. But the bigger thing, Prateek, is that is only 5 million tons. I have had 1250 rupee of EBITDA per ton in India on a much higher volume. Of course, I am knocking off the impact of exchange rate and cost of bags, which we had to face. UAE operations are all bulk volume, so there's no bag cost over there. Without accounting for all the expenses in India, we are still at 1200 rupees per ton out of the 1253 average per ton. UAE, I believe they are doing well now. Volumes are picking up, prices have not fallen. And knowing the UAE economies, I think they will be the first one to turn the leaf, come up with some new programs for reviving the economy.
So, and obviously the UAE operations benefit from the construction demand wherever it is required.
And sequentially, UAE had EBITDA of 267 crores in Q3 and 278 crores in Q4. So it's a stable journey.
Oh, so it's stable Q on Q EBITDA of UAE operations.
Yeah.
Okay. Other question is on, can you split your pending efficiency improvement program, which you have given 185 rupees you have?
Yeah, actually, I forgot to talk about it. I should have thumped my hand on the table and told you. I promised and we have delivered. So we are at almost 185 rupees per ton on nominal basis. We have completed, and all these programs which are there, which will take us beyond 300, whilst we had committed 300, because I'm keeping let's say an emergency or a buffer in my pocket, but I think we will deliver higher than $300. This is what you're looking at? Yeah. So we are looking at a number higher than $300 per ton. Fiscal 27 also we should cross significantly higher. Without giving a number upfront, I have a paper in front of me, but yes, we will deliver higher than $300 by fiscal 28. I've highlighted all the parameters and how they are getting quantified and measured. I don't know what else to add further.
Sure, thank you. These are my questions.
All right, thanks, Prateek.
Thank you. We take the next question from the line of Amit Kumar Moraka from Axis Capital. Please go ahead.
Hi. Thanks for the opportunity and congratulations on a great result. Just on the couple of data points, we just wanted to understand better. So in the presentation, you've mentioned that your other brand sales volume was 7.4 odd million tons in FY26. So is it fair to assume this number will be close to zero in 28, given that full transition has happened now for
Yeah. So, 7.34 in 26 and 0.52 in Q4. Okay, 0.52 may say 0.39 was India Cement and balance was Kesoram old brand. So this is all gone now. Next quarter you won't see it.
Yes, almost zero.
Great. And also on the trade non-trade mix, seems to be now 65-35. I think is a bit higher than 70-30 earlier. So again, on this mix particularly, would it be because in the presentation I also see that the industrial or infrastructure was a bit muted in the quarter, but still this number is a bit elevated. So wanted to understand, is this going to be now a sustainable mix, or would you like to kind of take it higher again?
I have seen it fluctuating between 65, 67, 68. Yeah, this has been the narrative, or this has been the broad mix. And what you saw in infra 2 red marks that we have given is again a temporary last quarter, because things got over in one, let's say Gujarat, when The high-speed rail project has passed through it. The work is coming to an end. That's why you saw a red mark there. But otherwise, I'm sure the government, the way everybody knows that infra is the foundation for growth, it will keep on happening. West, I think I'll have to create a darker green color for infrastructure going forward, because the way Mumbai, and I'm quoting the newspapers, yesterday or day before or one day earlier, when the newspapers gave a summary of how Mumbai is shaping up. 2035 will be totally new phase of Mumbai, $60 billion being spent here. So things are happening in the country.
Understood. And just one last question, if I may. Also on the clinker conversion ratio, it's now 1.48x. How much more can it go to, let's say, in the next 1 to 2 years? We have
targeted to reach about 1.54x. That roadmap is already there, and let's see how things shape up beyond that.
Got it. Thanks. That's all from me, and best of luck.
Thank you.
Thank you. We take the next question from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, Mr. Daga. Thank you for the opportunity and great set of numbers as always. Two questions. In the last few weeks of March or early weeks of April, have you seen any concerns on availability because of the conflict, be it bags or pet coke, where you have found it difficult to source even at a
No problems.
All right.
Our dispatches have not suffered at any location in the country. Bag availability has not been a crisis. It has become expensive, but it is not a crisis.
Sure. Second, barring cement, all other building materials have become a lot more expensive, as you mentioned, steel, if you look at PVC or other commodities as well. Is it causing a demand concern for the overall IHB segment?
Too early to say that. We have taken increases for cement. Industry has taken price increases for cement in the month of April. And by and large, we don't see slowdown in demand. Now, everything can be explained. People will have an explanation, too much of heat, because of which there's a slowdown. But election, Bengal and Tamil Nadu elections resulted in a slowdown just before the last 15 days. You see a slowdown. But generally, I think the undercurrent remains strong.
Sure. And lastly, if I may, per your best estimate, what would have been the industry growth for March quarter?
Six to 7% is what my learned team over here tells me.
Sure. Thank you. That's all from me.
Thank you.
Thank you. We take the next question from the line of Jashandeep Singh Chadha from Nomura. Please go ahead.
Hello. Good evening, sir, and thank you for the opportunity and congratulations on a very good set of numbers. So my first question is regarding India Cement. As you have highlighted that 100% brand integration is done, and you also highlighted that only a small portion of volumes was under India Cement brand. I just wanted to understand that the delta of incremental EBITDA per ton for reaching 1,000 rupees per ton, how much of that will come from the cost efficiency measures that you are undertaking and realization improvement? So if you can give a sense of, because I believe most of your India Cement volumes are already selling under UltraTech brand. So how much more potential is there for realization improvement, and how much cost efficiency measures will be there? That's my first question.
Jashandeep, hi. So first and foremost, cost improvement programs, and again, I'll go back to my earlier quarter commentaries. January, March 28, you will see all the efforts on CAPEX converting into efficiency improvement. We are still seeing 200 per ton of efficiency improvement which will come into the kitty of India Cements. Now it all depends. Second point, and I'll come to your one more aspect that you raised. How do we look at the earnings from the volume of India Cements? Mind you, there is 200 rupees of EBITDA per ton on India Cements volume, which is sitting in UltraTech books. The 497, yeah. 497 for the quarter, and because of during the quarter, gradually the transition was done. It's not exactly 200, but about 176.
670 is the number.
Total is 670. Okay. So we have reached a number of 670 per ton on India Cements. Now, if price increases along with efficiencies, new capacity addition, operating leverage, everything will take us beyond 1,000 rupees mark.
Understood, sir. Understood. And I'll ask my second question. It's a two-part question. So first is how you are looking at rural demand. How is that it has been in the March quarter, and in April also how you are looking at rural demand. And second is I understand that UltraTech at the scale at which it operates, you will have multiple measures to mitigate this cost increase. But let's say without those measures, what sort of realization improvement will be required to maintain the margins? These are my two questions.
So you have asked 3 or 4 questions, and I'll restrict you to 2 questions. So the last question I will eliminate because that's a very difficult question. Difficult to quantify. As far as rural demand is concerned, we have operated at 90% capacity utilization across our network. Some plants would have operated at 95% and 100% also, and averages all across the country we are operating at more than 80%. If you marry this point to the fact that our trade mix has not diluted, we are 66, 67, hovering around those numbers only, which means my rural demand has continued to stay steady. I hope that answers your question. And too early to talk about the important aspect. Cash flows in rural markets improve with good crops, which helps the rural demand. And too early to say now for the quarter how things will pan out in the remaining 3 months. Remaining 2 months we will see. As for your other point you mentioned, it's a moving target. Costs. Let's say bags from 9 rupees to 15 rupees a bag. That's a 6 rupee delta which has already happened. So that much price increase is required. Similarly, fuel is a very difficult one. At least this quarter, I don't expect my fuel cost to go haywire. We were at 1.81 or
1.77.
Sorry, 1.77 per kcal. Max it might go to 1.8. So that's the only, and I'm just throwing this number off the cuff. I don't remember exactly where we will land at. The biggest impact which was there in our EBITDA profile was exchange. Dollar 94.85 and today it is 94, Saurabh? 94.2. It had come to below 93 also. The quarter end reporting what is required remains to be seen. So price increases that have already happened will, in my view, sustain the profitability.
Understood, sir. I know you don't like answering price hike questions, so I was trying to hide it. But thank you so much. I'll join back with you.
Yeah, I'm also slightly smart. Chaliye.
Thanks.
Thank you.
Thank you. Ladies and gentlemen, a reminder, please restrict to 2 questions per participant and rejoin the question queue. We take the next question from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, hi sir. Congrats for a good set of numbers. I have 4 questions, if you allow. So first is
only 2.
Okay. Sir, 2A and 2B. One is India Cement. We're doing the right things. When do we see the day when we actually merge it? I understand there are a few legal cases which are there, but any timelines over here? Second, not so related, RBC, it's something which the group has pursued. Any assurance from you that UltraTech's balance sheet won't be touched, or it's something which is ring-fenced? I'll just wait over here. If you allow, then I'll go for the other two, sir.
So the second question, I think our chairman himself had said UltraTech's balance sheet is ring-fenced long ago when aspersions were made about UltraTech supporting Vodafone Idea. I think those were the days. I'm going back. Not a penny has moved from UltraTech balance sheet for any other purposes. So we remain committed. And again, as I said, unless you missed the point, I have 10,000 crore of capex happening every year, at least for 4-5 years going forward. That's about 50,000 crores of incremental capex. Okay, so my operating cash flows is meant for meeting my capex requirements and for my shareholders.
Perfect.
Sounds good?
Sir, India Cement? Yes, sir. India Cement?
Cement, yeah. So there are those complicated legal issues which we have inherited. We, as I mentioned, we don't want to take any risks with UltraTech, the main company, and our main board. Once we are able to, and we are trying our level best to get those cases closed, because they are donkey's years old cases and there's been no movement, nothing. Once we are convinced that these there is no risk to us, we could look at the next phase of integration.
Sure. Sir, I'll just try my luck. Sir, third question, RMC, we have done very well. What's the end goal over here? I think the number of plants, revenue growth is more than volume growth. What is correct that we are doing over here, and eventually in plans to monetize this particular business? That's on RMC. Second, sir, ESG clinker factor, you indicated our target is 1.54x. Just wanted to get a sense by what year is this, and how do you see the industry's ratio equivalent to 1.54x going forward? I understand we are OPC heavy and we have historically maintained that whatever we do, we will have clinker backing at 70%. Is it something which will change going forward, or we continue to play on the same hypothesis?
We will always be fully clinker backed. Second point, 1.54 is our target to reach by fiscal 28. I don't want to comment about the industry, but all I can say is UltraTech is a far stronger company in all aspects as compared to rest of the industry. Quarter after quarter, and there's enough, I don't have to say enough data, but actual data which is available. If you just sum up the performance of cement industry, rest of industry put together, and UltraTech on one side, we have delivered growth higher than the industry, EBITDA per ton higher than the rest of the industry. So this doesn't come by magic. All the efforts, whether it is clinker conversion, which means composite cement, which gives me more profitability, RMC, or all other aspects of our business which we are doing, which help us to be far ahead. As for RMC is an integral part of our business. I don't see a need or don't see that thought process as of now to monetize it.
We will eventual targets?
Sorry, what?
Sir, eventual targets on RMC?
A target in terms of number of plants?
So we are 3% of the volumes. Like, is there a target to go to 6% in 3 years, something of that sort?
Not really. Not really in terms of percentage, but yes, we would continue to grow because RMC is the the future growth engine. So obviously the more and more urbanization is happening, I think the RMC is going to be.
I think we are invested for the future, Ritesh, to be honest, to meet the requirements. And if you look at our UAE business, it is zero trade sale. It's all sales to RMC people. So, or globally, US markets or anywhere else you see, they are globally bag cement to बहुत कम जगह होता है. So, RMC is an integral part of our offering and of our business model.
Sure. Sir, I have one more question. Probably I'll join back with you. Try my luck.
This is 10A. Okay. Next one, please. Next
Cool.
person.
Thank you.
Yeah.
Thanks.
Thank you. We take the next question from the line of Pinakin from HSBC. Please go ahead.
Thank you very much, sir. So congratulations on a great numbers. So one question we keep on getting from investors over the last few months is that the other industries like steel and agri and PVC have taken aggressive price hikes in the face of cost pressures, but the cement industry has struggled to raise prices. Starting November, the price hikes have been relatively muted, even as demand has been strong. What would you attribute the cement's relative underperformance versus other building material industries in terms of taking price hikes?
Fragmentation of the industry is as sweet and small answer, Pinakin, that I can give you. Yeah, I think that would sum up everything.
So, sir, just taking that point forward to the second question, assuming, sir, that the Middle East conflict stays where it is, we have petcoke at 160, oil at $100 a barrel for this calendar year. Does this mean that the industry would struggle to pass on fully the cost pressures eventually this year?
No, we are already passing on if every industry is passing on the cost, so are we. March, somebody had asked me why prices are not going up in the month of March. March is never a period to increase prices because it's a volume period. Price increases always happen. And every industry has its own fabric and own pattern of behavior. July, September, monsoons impact cement industry only. So price increases generally are seen in the first quarter of the financial year, not in the last quarter of the financial year. And Pinakin, besides, obviously, demand supply is always there. If demand is robust, prices go up. And you are there, I am also here. आज ही के दिन अगले क्वार्टर फिर मिलेंगे. We will talk and we'll demonstrate. I think UltraTech will be steps ahead in terms of performance.
Got it. Thank you very much, sir.
Thanks, Pinakin.
Thank you. We take the next question from the line of Rashi from Citigroup. Please go ahead.
Thank you. So just on your point that the fuel cost will go from 1.77 to 1.8 in the quarter, this is due to your long-term contracts, right?
Multiple things, long-term contracts, inventory, sourcing, changing the fuel mix, multiple things.
So how long do your contracts and inventory last? As in, I'm just trying to understand that should the situation persist wherein petcoke prices sustain at like the 160 or 160 plus, when do you start feeling the impact?
July, September would be some ripples that you will see, again, which we will be able to manage better than the industry because of our supply contracts and domestic sources of coal.
So on these,
please end the war early, Rashi. Why are you wanting it prolonged?
No, I'm just trying to gauge that on your supply contracts. Like, how do these work? Like, do you have them going on? I mean, it's a continuous rotation, and therefore this can persist.
Yes, it can persist. It will persist.
Okay. And on the packaging side, between the fourth quarter to now, what is going to be the delta?
Fourth quarter to now, roughly 9 rupees a bag.
Yeah, fourth quarter to now, there was some increase and there was some decrease also. So I would say it should remain in the same range.
Not 9, sorry, 6 rupees a bag, sorry.
Yeah.
9 to 15, so it's about 6 rupees a bag.
So essentially, the price hikes that the industry has taken should be, in your opinion, adequate for you to offset the
Yes.
6 rupees.
Yes.
Okay. And just on the industry demand, you mentioned that the industry demand likely grew at 6 to 7% in this quarter.
Yeah.
Full year number is again similar?
6.5 is what my colleagues tell me for the full year.
And your volume as an UltraTech's volume expectations for FY27, like growth wise?
For 27?
For fiscal 27, your volume.
Next financial year. Oh, we would target double-digit growth.
Okay, got it. Okay, thank you.
Thanks.
Thank you. We take the next question from the line of Ashish Jain from Macquarie. Please go ahead.
Hi, sir. Good evening. Sir, my first question is, the price hike is sufficient to offset cost. In that, you are factoring coal cost also, or just packing cost? Given coal, you said will not impact in June.
I'm factoring in everything.
Oh, okay. So secondly,
except for if you take dollar to 100 rupees, that I'm not factoring in, which is a notional debit to P&L at the end of the quarter.
And diesel as well, which we will know when we will know.
Yeah. That has not been factored in.
Yeah. So secondly, earlier on the call, I think you said that there is a mark-to-market hit on your forex loan. Can you quantify that, and is it above EBITDA?
What do you mean above EBITDA? It's part of my cost. Yeah, it's within EBITDA. It's not an extraordinary item, not a finance cost. Correct?
Yeah, it is a hit to EBITDA.
Yeah, hit to EBITDA.
So can you quantify that?
About 140.
30 rupees.
30 rupees a ton. 120 and 30. Yeah.
Okay, got it. So secondly, you also said that packing cost impact was felt only in March month. And if I heard you right, you said it is 90 crores just for the month. Did I hear you right?
Yes, you did.
So shall we assume that that's the run rate which will continue given there is no relief on packing?
No. Because as Jamarji also mentioned, prices have stabilized. We have built volumes of our inventories and doing alternate sources. Mind you, nobody, I think, would have as many sources like UltraTech does. We have almost 150 suppliers across the country supporting us with bags. We are doing some other things also to ensure we are able to source bags and maintain costs. So 90 crores was a hit, which was the cost of the bag had gone up further also beyond 15 rupees. Then it stabilized to 15, or even today would be 13 or 14.
Marginally reduced.
Yeah, it's marginally reduced. So not 90 crores cannot be analyzed.
Okay.
More importantly, Ashish, we have taken care of that with price increases.
Right. Okay. Sir, lastly, just on pricing, if you can, shall we think that given the kind of cost inflation and all, price hike is here to stay, or you are seeing some pushback in terms of the channel or demand impact? Are you seeing that kind of concerns on?
I believe it's here to stay, because this is impacting every cement player in the country, in every nook and corner.
Right.
It's not a one-off. It's not one region. Everybody is getting impacted. So everybody wants to protect their balance sheet and P&L.
Right. Sir, my second question just on India Cement. Given some of the EBITDA of India Cement is getting booked in UltraTech standalone, your 1,000 rupees per ton guidance includes that, or that is what India Cement can eventually report, you think, in spite of the tolling agreement?
I'm sorry, I missed your question. What did you say?
Even some of the EBITDA per ton of India Cement is getting booked in UltraTech standalone because of the tolling arrangement and the sales being done by UltraTech. The 1,000 rupee guidance which you speak for India Cement includes that one which is getting booked in UltraTech, or it is pure India Cement EBITDA per ton which will come purely through cost savings and all?
Yeah, so all inclusive. So you will
All
say
inclusive.
800 in India Cement books and 200 of that coming in UltraTech books. But again, Ashish, don't get disheartened, because when we have committed 300 rupees of cost improvements and already delivered 185, as precise and to the second decimal, I'm also saying that we will do more than 300 bucks. So that gives you some indication of
For sure.
with India Cements.
Yeah.